So my name is Sarah Jane Mahmud, and I'm a senior regulatory analyst with Bloomberg Intelligence, the company's investment research division. It's been an interesting and exciting year in the world of cryptos. Despite significant volatility, there remains much excitement and speculation. And this will continue into 2019, but challenges do lie ahead, chiefly in the form of new regulation. To many, crypto assets present a new system of payment transfer that can over shortfalls in the traditional banking and payment services sector. They are also a great tool for quick, easy capital raising, which is becoming more and more widespread. This year, over $21 billion has been raised in over 900 initial coin offerings across the globe, up 3 times since 2017. Yet crypto assets do offer risks as well as opportunities, mainly because they are unregulated across most of Europe. Their unregulated nature makes them vulnerable to fraud, manipulation, and money laundering. So the authorities, from the European Commission to the UK Financial Conduct Authority, want to regulate this space. But to be quite frank, they've not really been sure how to do this because it's a very new, quickly growing area. So to date, most of the regulators have adopted a wait-and-see approach. They've taken time to assess the market carefully, and I think in 2019 they will definitely be ready to introduce new crypto asset controls. So currently, as I mentioned, crypto assets do remain unregulated across most European markets, with the exception of Malta and Gibraltar, giving rise to several risks. And this is why the Bank for International Settlements, Augustine Carstens, has once labeled them as a mix of a bubble, a Ponzi scheme, and an environmental disaster. In brief, the key problem here is that investor protection is weak. There's no safety net like a bank deposit guarantee fund to alleviate losses in the event that an exchange or a wallet provider fails. And moreover, digital currencies are not issued or guaranteed by a central bank or public authority, so they don't have the same legal status as other forms of monetary tender do. In time, wide-scale use of digital currencies could threaten market stability without regulatory intervention. And the risks are quite high if investors can't exchange a virtual currency for a traditional one at a stable exchange rate in adverse times. And interconnectedness with the banking system could also increase challenges. But for now, this isn't a direct threat, as the instruments are not so widely used to make payments, and banks don't have overly significant exposures. But this could change as cryptocurrencies are becoming ever more popular, and this is something that the Bank of England has said that it is keeping under constant review. It should also be remembered that heavy reliance on digital technology does render the sector vulnerable to cyber attack. And a hack usually results in substantial losses, such as at Japan's digital currency exchange Zaif, which suffered a $60 million hit in September, and Coincheck's $500 million attack in the first quarter of this year. And little regulation in this space does mean that it's hard for investors to recover their money. Another concern that is also quite interesting is around crypto's carbon footprint, with reports circulating that Bitcoin mining is actually more polluting than gold mining and uses around 52 terawatt hours a year, equivalent to the entire electricity consumption of Romania. And there are also estimates floating around that just one Bitcoin transaction consumes around the same energy as 100,000 Visa transactions. So when you look at regulation in Europe and you look at the EU Sustainable Finance Action Plan that came out of the European Commission this March, it's kind of interesting to see how both go hand in hand. Now, new anti-money laundering rules in the form of the 5th EU Anti-Money Laundering Directive, or AMLD5 for short, must take effect in every EU country by the 10th of January 2020. And EU countries, including the UK, are now in the process of transposing this into their own local laws. And the directive will, for the very first time, bring cryptocurrency exchanges and custodian wallet providers within the scope of the bloc's anti-money laundering regime. And this is designed to help regulators detect suspicious and criminal activity. Under the new EU rule, virtual currency exchanges and custodian wallet providers will need to secure authorization to act from their local regulator, so in the UK, the Financial Conduct Authority. and they'll have to apply due diligence to new and existing customers, as well as any beneficial owners, stripping the system of anonymity. This could also make the entire transaction process more costly and time-consuming. I think it's quite interesting that Estonia is the first country to have integrated this law only a few weeks ago. And looking at the UK situation, the UK government is under pressure to transpose AMLD5 into local law well ahead of the 2020 deadline. And that's mainly to account for the Brexit uncertainty and related concerns over regulatory divergence and also financial stability in the event of the UK leaving the EU. So currently, looking at initial coin offerings, whether an ICO falls within the regulatory regime is decided on a case-by-case basis, which obviously isn't ideal. Each token or token offering is different, as different rights are attached to particular tokens. So there's no generally accepted or standardized model and no harmonized regulatory regime. Many do fall outside scope, yet depending on how they're structured, some may involve regulated investments, and firms involved in an ICO may be conducting regulated activities. So if a token is structured and tradable in a way that resembles a common financial instrument, it could trigger application, for example, of the Prospectus Directive, the Alternative Investment Fund Managers Directive, or MiFID II. And if it falls within the technical definition of a transferable security, within the meaning of MiFID II, for example, a prospectus must then be prepared before the offer to the public or admission to trading. The European Commission is currently looking at how best to regulate ICOs, and they have said that a report could be due out by the end of this year, but I think it's likely to slip into the first quarter of next year. Now, separately, the European Parliament is calling for a new regulation on ICOs, arising out of a separate regulation on crowdfunding that came out this March. The Parliament's committee is actually arguing that crowdfunding service providers should be permitted to raise capital through their platforms using cryptocurrencies, so long as they comply with certain regulatory requirements. And this proposed regulation would require crowdfunding services providers to ensure that prospective investors are provided with a key investment information document, or KID, from the project owners, setting out a raft of information, including details of the identity, the legal status, ownership, and management of the project owners, a link to their most recent financial statement, and much more. But this rule would only apply to public sales that raise less than 8 million euros, so obviously its application would be limited. It's still being discussed at Parliament level, so it could be many years until this actually comes into force. Meanwhile, cryptos are also in focus in France, and it was the subject of the AMF, the French Securities Regulators' annual conference that I attended in Paris a few weeks ago. The French regulators are proposing an optional visa for ICOs that fall outside the French regime in a draft law called Pacte, I think that's the pronunciation, that's now in discussion in the Parliament. So under this proposal, issuers with a visa would appear on a white list that the AMF would communicate to the public. And this will show that the issuers comply with regulations and provide potential subscribers with evidence of respectability. The law would also allow certain professional investment funds to invest in digital assets that have been reliably validated and present sufficient liquidity in order to allow the fund to comply with their obligations concerning the execution of redemptions to unit holders and to shareholders. And finally, EU regulators could seek inspiration from what's been going on in Malta. I think the regulator there is pretty much a leader in crypto regulation in Europe. The Virtual Financial Assets Act came into force only on the 1st of November. And this act outlines many detailed conditions that must be met by new cryptocurrencies that are launching in the country, as well as those that must be met by crypto exchanges, wallet providers, and portfolio managers too. Now, back in the UK, I think the UK regulators are likely to act very fast next year. Only a few months ago, this September, the House of Commons Treasury Select Committee published a long-awaited report on cryptocurrencies after interviewing several key figures from the Financial Conduct Authority, the Bank of England, and also from industry. And its report stresses that the introduction of regulation must be treated as a matter of some urgency. But it also does highlight that if the UK develops the right regulatory environment for crypto assets, so one that's not too loose, one that's not too tight and restrictive, the UK could be well placed to become a global centre for this activity despite Brexit. Also, they believe the entry of institutional investors into this market would increase liquidity, which would in turn further reduce some of the inherent risks that I outlined earlier to you. So in the UK, what can we expect next? Well, first, new anti-money laundering rules will be implemented in haste next year. And regulators will also seek to bring crypto assets fully within the FCA's remit by extending the regulated activities order, as opposed to creating a new bespoke regime from scratch, which would take many, many years, and that would not be sufficient to counter the risks. Meanwhile, the Bank of England will continue to assess the adequacy of prudential regulation, including on capital, that applies to the crypto-related exposures of banks, insurers, and larger investment firms operating in the UK. And the FCA has indicated that by year end, it will be consulting on making the temporary EU ban on retail crypto derivatives permanent in the UK. And finally, in January, HMRC is expected to clarify issues around the tax treatment in the sector. So finally, just before closing, I would like to give you a brief overview of Bloomberg Intelligence. BI provides global research on industries and companies, as well as government, litigation, credit, ESG trends. As a regulatory analyst for BI and a former solicitor, I look at the financial services industry with a different lens. I track regulatory issues and assess their likely impact on various parts of the sector, from the very first consultation right through to implementation. And I find that this helps to provide a unique perspective on the industry because regulation is becoming more and more important. Over the past 4 years or so in the department, I've covered wide-ranging issues, from cryptocurrency controls to more general fintech policy, both at EU level and in the UK, and also MiFID II to Brexit and so much more. All of our research is available on the Bloomberg Intelligence portal at BIGO, and it is available to you on the Bloomberg terminal. Now, specifically, our research on crypto assets can be found on the BI dashboard, BI FTech Go. And here you will also find content written by my colleagues in the US, Mike McGlone, a US commodity strategist, and Ben Elliott, Washington policy analyst, as well as my research on regulatory developments over here in Europe. And finally, I'll give a shameless plug for our Financial Regulation Outlook webinar that's set for the 16th of January, as the treatment of crypto assets both in the US and in Europe will be a big focus of that. Thank you very much for your time and enjoy the rest of the conference.